Central banks are trying to achieve low and stable inflation, but they operate in an environment in which various forces may be destabilizing. What are the causes of inflation volatility? In this segment, we'll provide a taxonomy of potential causes of inflation volatility, dividing them into push and pull factors. The central bank's best policy choice can depend on the precise nature of the destabilizing forces. Push factors come from supply-side pressures on the cost of production. The volatile global prices of commodities, including energy and food, are a particular source of supply-side factors. Pull factors come from demand-side pressures on the purchases of domestic goods. Rising and falling expenditure pressures are referred to as business cycles, which are measured by the output gap, the percentage deviation between demand for goods and the long-term production capacity of the economy. To identify demand-side pressures, we look at the core inflation in goods not directly affected by volatile swings in commodities prices. After viewing this segment, you should be able to 1. Distinguish supply-side shocks from demand-side shocks. 2. Calculate the output gap. 3. Characterize cyclical inflation movements. Inflation is driven by a number of factors. These include supply-side factors, which come from production costs, exchange rates from the external sector, and demand pull factors, which are driven by consumers. In this module, we'll concentrate on the internal factors and examine exchange rates in the next module. We simplify the analysis by decomposing inflation into commodity price inflation and core inflation, or inflation in core goods. Commodities are oil, agricultural products, and minerals. Core goods include clothing, most services such as healthcare spending and rent, and consumer durable goods. We measure core inflation by abstracting from commodity price inflation and sometimes inflation in regulated prices. Core inflation excludes inflation in volatile commodities markets, and in some cases the prices of goods administered by the regulatory state, such as transport costs. Developing markets may tend to have relatively large shares of the consumer price index concentrated on food commodities. Thus, the broader CPI is more exposed to commodity prices in emerging markets than in advanced economies. Energy costs tend to be somewhere around 10% of the consumer market basket, particularly in the higher income economies, so advanced economies are more conscious of energy prices. We associate commodities prices with supply-side factors. The dominant supply-side factors will be the volatility of commodities. Demand pull factors will be associated with core inflation. Compare core inflation in Japan with headline inflation, which measures price changes in the broader market basket of goods. Core inflation in Japan is defined as the growth in the CPI, excluding energy and fresh food. With the exception of a rise in the sales tax in 2014, core inflation has stayed fairly stable. Examine the path of headline inflation, which is more volatile. Commodities inflation is often driven by global factors, for example, global oil prices measured in US dollars per barrel. When oil prices are rapidly accelerating, for example, prior to 2008, headline inflation runs much faster than core inflation. Following a sharp fall in oil prices, headline inflation will tend to be below core inflation. Note that the deviations of headline inflation and core inflation are typically short-lived. Changes in energy prices tend to flow through into prices quickly. Core inflation tends to be driven by the level of economic activity, in particular, broad demand for goods and services. The chief measure of aggregate demand is called gross domestic product, or GDP. GDP is measured by national statistical authorities using survey techniques. GDP is defined as the dollar value of goods and services purchased, adjusted over time for inflation. The most popular method for calculating GDP is to survey different categories of buyers: the household sector, the business sector, and the public sector. Also included is demand from other countries, measured as the trade balance. Inflation depends on the pressure that demand puts on the available supply of goods. We measure long-term production capacity as potential output. This is typically defined as a production capacity that society can achieve without throwing labor markets out of balance and reducing productivity relative to labor costs. There are a variety of theoretical and statistical models that are used by central banks to measure potential output or potential GDP. Potential output will tend to be smoother than actual GDP measuring expenditure. The single measure that we use to estimate the pressure that demand-side factors are having on inflation is the output gap. This is simply defined as the percentage deviation of spending, i.e. GDP, from production potential, i.e. potential GDP. This is defined as the difference between GDP and potential GDP divided by potential GDP. For example, in the fourth quarter of 2012, Japanese GDP was approximately 5.17 trillion yen, while potential GDP was estimated by the Bank of Japan to be 5.26 trillion. Calculate the output gap as negative 0.0162 or negative 1.62%. The output gap is the main measure of the business cycle. We see a measure of the output gap for Japan, which deviates positively and negatively away from the long-term trend. What drives this instability? Many factors beyond the control of central banks will impact aggregate demand. These include animal spirits, which we can think of as the optimism or confidence of the household and business sector. When consumers are confident, household expenditure will increase and the output gap will expand. When the business sector is more optimistic, corporate investment will increase. Conditions in stock and real estate markets also impact demand. When asset prices are elevated, households are rich and demand increases. Fiscal policy also matters. When the government spends more or cuts taxes, demand will increase. The output gap is the main single measure of the business cycle and is associated with many aspects of economic performance. For example, there is a strong negative association between the output gap and the unemployment rate. When demand for goods is high, firms will need to hire workers. So when the output gap is strongly positive, it will be easy to find a job and the unemployment rate will be low. We see a positive relationship between demand for goods and the profitability of the industrial sector, as measured by operating profits as a fraction of total assets. Corporate profit rates are closely connected to the output gap. When demand is high, it is easy to sell goods and make higher profits. Fluctuations in the output gap are also associated with financial instability. When the output gap is high, stock prices, relative to the quantity of dividends, is also high. When the output gap is low, stock prices will also be low. Most importantly for our purposes, we can see the connection between demand-side pressures and inflation in Japan by comparing core inflation, defined as year-on-year growth in the CPI, excluding food and energy, and the output gap from the previous year. Over the period 1983 to 2016, we can observe a strong positive connection between the output gap and core inflation. When customers are buying intensively, producers will respond by producing above a sustainable rate and raising prices. Thus, when the output gap increases, core inflation does as well. As we have seen, business cycle instability leads to instability in inflation in labor markets and financial markets. When animal spirits are expansionary, the output gap will increase. When firms are selling more, they make more profits and hire more workers. These pressures will pass through into inflation. After completing this segment, you should be able to 1. Distinguish supply-side shocks from demand shocks. 2. Calculate the output gap. And 3. Characterize cyclical inflation movements. As we wrap up, let's conclude by summarizing the key question. We divide the causes of inflation instability into demand-side factors and supply-side factors. What are the causes of inflation volatility? Most prominently on the supply side, volatile commodities prices pass through into inflation. Energy prices and food prices are especially exposed to global commodities prices. Statistical authorities construct a measure of inflation in non-energy and non-food goods called core inflation. Core inflation is more exposed to cyclical demand-side factors. We measure the business cycle with the output gap, the percentage difference between demand for goods and production potential. When demand is strong, firms raise prices and core inflation is high, and when demand is low, the reverse will be true. Now that we've learned how the economy can destabilize inflation, we'll learn how the central bank can use monetary policy to stabilize inflation.